The story begins in 1926, when the Royal Commission on Indian Currency and Finance recommended a central bank for India. After years of debate, the Reserve Bank of India was finally established on 1 April 1935, with a capital of just 5 crores. Initially, it even served Burma and Pakistan, before becoming fully nationalized in 1945. The RBI Act gives the Reserve Bank its core mission to regulate the issue of currency notes, maintain monetary stability, and manage India's credit system. In simple terms, it's RBI's rulebook for keeping our economy stable and growing. The Act is divided into 5 chapters, from preliminary definitions to incorporation and management, central banking functions, general provisions, and penalties. Plus, 2 schedules, one defining RBI as territories, and the other listing scheduled banks. Some highlights. Section 22 gives RBI the sole right to issue currency notes. Section 26 makes those notes legal tender, guaranteed by the government. Section 42 requires banks to maintain their cash reserve ratio with RBI. And Section 40 empowers RBI to regulate foreign exchange transactions. Yes, even RBI can be overruled, but only by the central government. The Act also covers non-banking financial companies, derivatives, and even sets up the Monetary Policy Committee, the MPC, which decides repo rates and inflation targets. In short, RBI doesn't just print money, it shapes the entire financial ecosystem. Now, let's move to the Banking Regulation Act. Originally called the Banking Companies Act, it was passed in 1949. This law defines what banking means, sets capital standards, regulates dividends, and ensures depositor protection. It gives RBI the power to license banks, inspect their books, and even take action if banks act against depositor interests. In short, RBI Act gives RBI its powers, while BR Act tells banks how to behave. Remember these key facts: RBI established in 1935, nationalized in 1949. Minimum capital for a universal bank, 200 crores. For a small finance bank, 100 crores. Payment banks can hold up to 2 lakhs per account. And yes, Google Pay is a techfin company. If you found this breakdown useful, hit like, share with your friends preparing for exams, and subscribe for more crisp explainers. Question number 1. When was the Reserve Bank of India nationalized? Option A, 1935. Option B, 1942. Option C, 1947. Option D, 1949. Answer, Option D, 1949. Explanation: RBI was nationalized on the 1st of January 1949 under the Reserve Bank Transfer of Public Ownership Act. Question number 2. Section of the RBI Act gives RBI the sole right to issue currency notes in India? Option A, Section 17. Option B, Section 22. Option C, Section 26. Option D, Section 42. Answer, Option B, Section 22. Explanation: Section 22 empowers RBI to issue banknotes. The central government cannot issue notes after this provision. Question number 3. Under Section 42 of the RBI Act, what must scheduled banks maintain with RBI? Option A, Statutory Liquidity Ratio, SLR. Option B, Cash Reserve Ratio, CRR. Option C, Capital Adequacy Ratio. Option D, Net Owned Funds. Answer, Option B, Cash Reserve Ratio, CRR. Explanation: scheduled banks must maintain CRR with RBI, based on their demand and time liabilities. Question number 4. Which chapter of the RBI Act deals with non-banking financial companies, NBFCs? Option A, Chapter 2. Option B, Chapter 3B. Option C, Chapter 3F. Option D, Chapter 4. Answer, Option B, Chapter 3B. Explanation: Chapter 3B contains provisions relating to NBFCs, including registration and regulation. Question number 5. The Banking Regulation Act, 1949 was originally known as Option A, Banking Companies Act, 1949. Option B, Indian Companies Act, 1913. Option C. Indian Banking Act, 1935. Option D. Reserve Bank Act, 1949. Answer. Option A. Banking Companies Act, 1949. Explanation: it was first passed as the Banking Companies Act in 1949, later renamed Banking Regulation Act. Question number 6. Which section of the RBI Act exempts RBI from paying income tax? Option A. Section 48. Option B. Section 49. Option C. Section 59. Option D. Section 30. Answer. Option A. Section 48. Explanation: Section 48 exempts RBI from income tax and super tax. Question number 7. Which body decides India's monetary policy, including repo rate and inflation targets? Option A. RBI Central Board. Option B. Ministry of Finance. Option C. Monetary Policy Committee, MPC. Option D. SEBI. Answer. Option C. Monetary Policy Committee, MPC. Explanation: the MPC, set up under Chapter 3F of the RBI Act, frames monetary policy decisions.